We are so delighted to welcome both Nathan, and Ben to Oklahoma in general. They both come from the coast, which will be interesting to get into that a little bit. You guys received a little bit of the bio from them, so I'm not going to go through it, but I would love for you guys to just give a quick glimpse of your firm, a little bit of your background, and maybe this trip that brought you to Tulsa, Oklahoma.
Go first. My name is Nitin Pachisia. I'm with Unshackled Ventures. We're an early stage fund investing in companies founded by immigrants in the US. Besides investing capital, we invest resources in taking over immigration so that the founders don't have to spend time on immigration and they can focus on building businesses, creating jobs. We make about 10 investments a year. We've now about 40 companies in the portfolio. We come here because a lot of our investments are in industrial technologies. We come here because a lot of the entrepreneurs that we would want to invest in are possibly here. When that Oklahoma-based entrepreneur starts the next Google, I want to be there, so I'm here.
Awesome, thank you.
And Ben Bayat, I'm with a firm called NextGen Venture Partners. And so we're kind of the next stage up and partners with Unshackled. When they incubate a company, we would be the next stage of financing in kind of a Series Seed or Series A round. And part of our strategy, and the reason we're called NextGen Venture Partners, is that we have a technology platform that connects us, the full-time team, our founders, and a 1,000-person plus venture partner network. And that venture partner network is sourced from places like Oklahoma, and Cleveland, where I went to school, and all throughout the United States, in which we think that the Bay Area has not, or the coasts have not cornered the market on innovation, and so we want to find the best deals wherever they are. And we've started a second strategy that's a growth fund to invest alongside our companies as they mature, to have continuity of capital.
So tell us, because for what would be a seed round for us, maybe a different type of round for you. So what do you mean by seed rounds? How big are the checks?
Anything above 10 million. No, no, so we were actually just kind of benchmarking with each other on the drive over. And I think what we kind of said is that under $1 million is kind of a pre-seed in the area. And then the seed rounds generally, and I should put context around this, that it does differ by what companies are doing. And so a lot of what I invest in is some type of software. And so that software, as a result, has less capital expenditure that you'll require. So a seed round in the software category is kind of $2 to $3 million in total size.
It might be useful to, because the names get confusing pretty quickly, to relate these to companies' business stage. And so a way to kind of decipher that is when you're an idea, you're validating with customers, you're trying to identify that high value problem and the solution to that problem. You haven't locked your first customer yet, you don't have a product yet, you're pre-seed. Once you have the validation, once you have that early customer movement, you are starting to get ready for a seed. And as that movement builds and you start building momentum with these customers, you start getting traction, you're moving towards the A. The size of the round is more dependent on what you need to get to the next milestone. So some companies may get there with a $1.5 million seed, others may need a $5 million seed.
That's very helpful.
Yeah, so can you guys expand a little bit on, I mean, I love that you guys are here, first of all. Why, can you expand a little bit more on why it's important for you guys to look at deal flow outside of traditional tech hubs? And is that something that's kind of unique to what you guys are doing, or do you see that as a trend that's you're starting to see with more and more VCs looking outside of the Bay? And
I might start with the second part first, which is, is this a growing trend, or how do we perceive this? I do think that there are kind of generations, so to speak, of investors within venture, and they take advantage of different innovation themes, and certainly a big changed in theme was cloud, from cloud computing that enabled a whole birth of a different type of startup. And my perspective is that the next extrapolation of that is by virtue of cloud computing and the ability for us to all be, if we want to, working remote and actually close sales via applications like Zoom or other things, that centers of, geographic centers of excellence will disperse. And so I think that it's a natural evolution for innovation to move within other geographies. So that's my perspective on that element of it.
The reason it's important to us is immigrant entrepreneurs who we focus on are everywhere in the country. The three big drivers of immigrants into the country are universities, corporations, and families. And they're not concentrated on the coast. They're everywhere. So that entrepreneur who's made a journey from wherever they were born and grew up to Oklahoma City or Tulsa or wherever they are now, expecting that they will make another journey to go to San Francisco or New York City because they want to start a company is an unfair expectation. Instead, we're now at a point where with technology that allows you to collaborate much better, with transportation that is much faster and more efficient, we can bring those resources from our respective regions to where the entrepreneur is. And we think if we start doing this, I hope that we're on the front end of that, such that we're going to reap the outlier benefits of it, and hopefully start a trend where other VCs start taking notice of that as well. Right now, what you have is too much concentration of entrepreneurs on the two coasts, and more specifically, San Francisco area, LA, and New York City, and so investors are content staying focused in those regions. But I look at this as for people like Ben and I who are building a differentiated firm, who are building our own startup in a way, it's important that we make ourselves available to the entrepreneur so that when we are the right investor for them, they know they have access to us.
They know about you guys. And it's super important. I think we've talked about this when I first reached out to you both. 78% of venture capital is spent on the coast. And so what we started noticing in our region was that a lot of entrepreneurs did actually feel like they would have to relocate in order to look for that capital. So it's great to have you here and to have that reverse, to have investors that realize, hey, it doesn't just have to be within our a certain mile radius from us. We actually can get out, perhaps get better deals on the cap table, better valuations, et cetera. So that's great to know. I want to dig a little bit into your investment thesis with immigrants, because we did also see a statistic that 50% of Fortune 500 companies were built by an immigrant founder or a son of an immigrant. Can you tell us a little bit about that specific niche? Where is the opportunity? What do you tell LPs? Because, by the way, our audience is not just entrepreneurs. We have investors here that are looking to invest in unique funds. So what is the pitch?
So I think you're giving me too much credit by calling it a thesis. We started out of desperation because I am an immigrant. I started my first company when I was on a visa, and through that process, just realized how much time is spent on non-company building efforts, just dealing with immigration. There's two kinds of delays you deal with, or two kinds of time sink. Either you delay the time of when you start your company. So you're waiting for your green card, which if you're from certain countries can now take 15 years. Exhibit A is right here. Another example of that is App Dynamics was started by Jyoti Bansal soon after he got his green card. He could have started that company much sooner. The second part of it is you don't wait for your green card and you just jump in and start your company, but then you're spending a lot of time dealing with immigration. That was what prompted us to start Unshackled Ventures, was take that burden off of the entrepreneur. And the inspiration for that came from watching other firms that have recently been more successful by amplifying founders' time. We were just talking about this in the car, is the era of just capital driving access is gone. The most successful investments or most successful VC funds will be where the VCs are doing something to amplify founders' time so that they can do what they are best at. what we have created is a mechanism to take over that immigration burden and access. Those are two things that we can bring to immigrant founders. And that's our thesis. Beyond that, we're not thematic. We invest in software, hardware, space tech, life sciences, food, industry. We're investing across the board, and we have a network which can help which can augment the entrepreneurs across these verticals. And we have an LP base who have built companies or businesses in these domains. So we get a lot of the knowledge base from our LPs and our networks. But the thesis does not revolve around what the founders are doing. The thesis revolves around these are exceptional entrepreneurs who, if given the opportunity, will build groundbreaking companies.
That's great. Is that the same for you? Are you also open to any industry, Ben, or are you more specific?
A little more specific relative to sector, but what Nitin was saying relative to capital flows to differentiated and reduction of barriers is really pervasive relative to most new funds. Ours, that technology platform and that 1,000-person venture partner network, is our hack of a way to unburden the founders with the first two asks. If they're not immigrants, immigrants probably say the first ask is, oh my God, how do I found this and still maintain citizenship or pathway to citizenship? On the other side, it's introduce me to customers that look like X, Y, and Z and help me hire people that look like A, B, and C. And so via our network, oftentimes other companies, when they're funded, they spend 6 months trying to just build a team. And we can dramatically reduce that time. And so that's kind of our approach from differentiation. Relative to sector, enterprise SaaS, digital health, next generation commerce, and a kind of a play bucket of frontier technology, which can include food, autonomous vehicles, things like that.
Yeah, so you're solving that access to social capital, right?
Yeah, exactly. Otherwise we would be, several partners that, partner time doesn't scale, whereas a network can.
So tell us a little bit about that background, though, because you started, and I think we have some folks in the audience too that started this way too. You started as an angel group, right? So it was an angel group, and then it naturally evolved to a fund. Can you walk us a little bit through how that got started?
Yeah, and I always joke that, so I joined the firm about a year ago in the Bay Area. I've been at venture capital for about the last 7 years. The firm was founded in Washington, D.C. as an angel group, and I don't think the firm would have been successful starting in the Bay Area, because you throw a rock and you hit an angel group, and you'll hit 3 founders in between, and so there was a bunch of lone wolves that were together hunting deals, so to speak, and they pulled resources, not just capital, but diligence, sourcing, etc. And that was the nascent group, and from that they attached a fund to it because time and deployment around capital is a big lever, and keeping the cap table clean is another element that founders care about. And so that was Fund 1, was a $22 million fund. Now we have a $60 million Fund 2, and a $50 million growth fund, and we do a bunch of SPVs. So it's kind of been a natural evolution through it, but the one constant has been individual time doesn't scale. But I often say that in any role, if you're kind of a deals person or a salesperson, early stage startup, you are all of those things as a founder. Your day is often like 7 a.m. to 7 p.m. meeting people, and then you come back. If you have a family, you have dinner, you put your kids to sleep, and then you triage your inbox. That's not a way to actually progress things, and so we can progress that by removing ourselves as the bottleneck.
Ben, you mentioned barriers, I think, a minute ago, and what would, in your opinion, what would be some of the biggest disadvantages maybe of being in this region? What can we do to maybe try to remove those barriers as we continue to try to grow the Midwest ecosystem here? And because if you throw a rock here, you don't hit a whole lot of angel investors.
Yet.
Just
we
just
throw a
as
lot
like
of
a general
rocks.
rule, by the way, you don't want to throw rocks and hit anybody, let alone angel investors. I mean, it's a great question. And it's one that, when we're doing these learning tours, if you will, it's seeing the commonalities. And I was having a conversation before where, access to early capital or concentration of capital is a challenge. And that's a ubiquitous challenge. We see that in a lot of places. I think that opportunities like this where networks can combine and you can make a connection, and by virtue of that connection, get introduced to the right folks is the starting point to it. I also think that talent is a challenge, right? And I would bet on any founding team in any geography, because it takes a certain unique individual to be able to step out on their own and bring something that from nothing to fruition. But once you go from like 0 to 10 employees that have that belief, going from 10 to 50, that next group of 40 folks, do you have the DNA in the area that knows hypergrowth, that knows those elements to it? So when we invest at seed, there's often just that 2, 3, 4 people. At the Series A and B, those investors, I think, are a little bit more hesitant about geographies, because at that point, they need to grow the company from 10 people to 100 people. And I don't know yet what the solve is for that.
I think the solve is creating access, and it takes time. There's no short-term cure to it. You have to keep at it. But the access is a two-way street, because for not every investor in Silicon Valley or New York City is looking to invest outside their region. So you have to qualify who is. And then from our perspective, if you look at it from the other side, the issue is, how do we get access to companies that are being formed here without adverse selection? So when an outsider is looking at an ecosystem, you're worried about adverse selection. Like a company that started here, why is their round not getting filled with local investors? Are we only getting second pickings, third pickings? So the way to address that is by building long-term relationships with investors in a way that you make room, local investors can make room for these investors in rounds that are oversubscribed. You start participating in rounds that they are investing in. One of the trends that I don't think are very healthy ways to solve this is insular investing, which is local wealth being invested in local entrepreneurs only. That does not create transfer of that knowledge that Ben was talking about, the mindset. It does not create relationships with investors outside your region who could potentially be co-investors in your deals down the road. So if you take a long-term view and you say, we're going to start building relationships, we're going to qualify investors who have shown the interest in investing in our startups here. We're going to build these relationships by showing good faith that we can start participating in your companies, and especially you can pick and choose. I was asking Erica, what are strengths of the region? She mentioned aerospace, for example, is a strength in the region. So if a company in Mountain View is building a solution for aerospace companies, could you participate in their seed round? That will only happen if you know some of the investors in that round, so you get invited into it. But you get room in the round because you can expose them to certain customers in your region. Now you've started building some deeper relationships. That's why it takes time. It's a long game. Unfortunately, there's no shortcut to it.
I love that, because one of the things that we see often in our region is that for whatever reason, whether it's the shortage there's not a shortage of capital in our region. There's actually a lot of wealth in our region. It just tends to be deployed in other type of assets, and or because of the concentration of where the fund managers are, there's a lot of fund managers that come here, raise here, and then they go back and do their individual funds. But one of the things that we have seen here is often we get into this mindset of filling in rounds with just local investors, which in my opinion can limit, I love that you said can limit even the founders, just an out of state perspective, right? Like it could be industry-wide, it could be knowing other investors that could lead your future round that's gonna be much harder to raise just by local investors. It's just that access and exposure to a larger network and if you're gonna build, hopefully, a company that's gonna scale to 100x, you can't be just an Oklahoma company, right? You can't just be a state company. You have to start building those networks. So I love that you mentioned that. We want to turn it around a little bit because there are some entrepreneurs here interested in, okay, so how do we approach VCs in the coast? And, tell us a little bit about how you like to be approached, and what you would coach entrepreneurs reaching out to you.
Be bold, be shameless, and be thoughtful. And I guess in the reverse order, though. So what I mean by that is thoughtful. So cold emails are good. Cold outreach is good as long as it's thoughtful. We get a lot of emails, and Ben is triaging those at 2 a.m. So, if it's thoughtful, it'll catch his attention. But if it's not thoughtful, it'll get deleted. So one part of it is qualifying who you are targeting, who you are sending it to. There is a trap where certain funds that are maybe more popular because you've heard of them, you're sending them emails, but they're not the right stage for you, or they don't invest in the industry that you're working in. So do your own research, qualify the investors you're reaching out to. Some will respond to your cold email, some will not. Don't worry about the ones that don't. It's their loss. They're missing on the opportunity. But if 4 of the 10 respond back, I would say that's a win. For us, for example, we've taken steps to open it up in a way that there's a form on our website that whether somebody's referred to me through someone I know or someone reaches out cold, they can share information through that form, and at least 2 people in our firm will look at everything that comes in. Nothing goes in a black hole. And so there are firms that have explicitly taken steps to be approachable and accessible to everyone. There are specific VCs or principals or associates at firms. The more you research, the more you'll find out. Twitter is a great tool, by the way, now. DM people, the more, and that's why I say be bold and shameless, is because just because 2 or 3 people didn't respond to your cold email, don't worry about it. Just keep going. Be more thoughtful and mindful about who you're reaching out to.
Ben?
Yeah, I was going to joke that most VCs are always available and never reachable, and like the contact information is there. It's easy, and so it really is being the right bird of a feather that connects on the opposite end of that. Because people are looking for either the right type of founder that's going to match the profile, or the right type of company that's going to match. And it's really simple when triaging that inbox when I get an investment in a movie production company. Like there's nothing about what we put out that would indicate that would be something that we'd be interested in. I'm sorry if there's 3 entrepreneurs in producing movies here, but any thoughtful research about what we've recently invested in is important. The other piece, this is a little specific to us, but most firms have something of an advisory network or some sort of network that's involved. We have 1,000 venture partners, and I don't know I forget the math around the Kevin Bacon game, but he could be one of our venture partners for all I know. And so the degrees of separation are close enough that there's somebody within our network that is 1 or 2 degrees of separation away from a founder. And so accessing through that, learning about us, having the right pathway in, we set it up to be accessible and reachable.
Yeah, just add one thing more specifically that learned through the previous Combaxities tours is there's a sense of being very modest. That is a very Midwest thing that I've learned. And so I would strongly encourage you to not be modest. Talk about that big, bold vision that made you start the company. Open with that. We're looking for big things. We're looking for crazy ideas. So the crazier it sounds, the more likely you are to get a response, even if it is to say, it sounds so crazy, I just want to hear, how is this even possible? And that's, now you've started a conversation. So don't tone it down just because you want to make it sound realistic.
We do suffer from the Oklahoma nice sometimes, and sometimes it's not a bad thing, I guess, sometimes. But another upside to Oklahoma is you can pretty much get in front of anybody you want to. We are 1 or 2 degrees of separation from if you need to get in front of somebody. So that's an advantage. So, assuming that an entrepreneur, we were talking with one of our entrepreneurs earlier about pitching and her future raise. They've done the due diligence. They've researched you guys. You are a good target for them. You do invest in their sector, their industry. What could they do in a pitch that would just turn you off?
Oh, so much. 199 out of every 200 things I see, we pass on. So that list is endless. Our investment rate is about 0.5, 0.6%. So, and that's when, immigrants in a company or one immigrant founder in a company is not that hard to find. So of the population, there's a lot of things for which investors may pass on an investment. And that's, in some cases, it's just because it's not a venture fundable business, or we couldn't see the conviction that this team can execute, like very basic things. In other cases, it just comes down to likability. I just couldn't trust the founders. I just couldn't hit that. And that's nothing about them needing to change anything. It's a chemistry thing. But there's also an element of, there's constant iteration going on all sides, because investors are evolving and entrepreneurs are evolving. And so when someone meets me and they get some feedback, they take that back, they learn from it. By the time they go meet the next investor at the right stage, that story's evolved. Google was passed on by 60 investors, I've heard. I don't know how they sleep, but whatever. The 61st was the beneficiary of the evolution of the narrative from the first 60 meetings. So there's a lot of change happening all the time, and therefore the reasons why somebody invests is a more finite question than why you would pass.
I'd only add that it's a combination of, it's a really hard dance. And that hard dance is trying to figure out how you can make a human connection, because at the stages that we're investing in, the human connection is you have to trust that person, and that's an important piece to it. But also deliver the right information in the pitch that meets the expectations of that investor. And some investors, maybe I'll make this very practical. There's a different deck for an angel investor than there is for an institutional venture investor. One common mistake I see is that people bring the same deck that they've been using, not just for any angel investor, but maybe the local angel investor that has a different set of aspirational expectations for the investment. And so from a very practical standpoint, just pitch to your audience. Just try to know your audience and nail it with them.
Goes back to researching, make sure you know who you're pitching, what they look for, and et cetera. But I think that what you said, both of you said, is very true, particularly because as we develop the ecosystem here, a lot of the investors that are here tend to be more traditional or latter stage. And so they expect the decks to be far more from what we get to see in the coast, which is like, come in with your crazy idea and just tell me how you're going to get there. Where here, it tends to be a lot more conservative, like it's all about the numbers, and if you're not even hitting the revenues. But I like what you said. Just make sure that you know who you're pitching to, and then cater your deck or your pitch to that person. It's just sometimes it's hard when you're here, because you most of the feedback that you get is from the local investors that maybe are not as they don't have the risk appetite or the prone to be. Let me ask you this: what would your advice be to investors that want to tap into the early stages?
What I was just going to say is, this is all like, we're here because we're exploring, we're learning, we're trying to figure out, what the appetite here is relative to the ecosystem. When we say that, it's founders, it's incubators, it's different startup partners like this, investors, LPs, et cetera. And each one of them has a different perspective on what the startup game looks like. And sorry, what was your what would I say to investors? What would you say to the investors? The venture backable returns is a specific type of investment, and having a perspective on what that means and the types of deals that you want to participate in, and or managers that you're interested in investing in their funds is going to correlate, generally speaking, to either a multiple or an IRR. And when you look at the potential outcome of any opportunity, if there is a possibility that this is a professional services business or that you're pushing them, we were talking in the car about, we oftentimes, one of the biggest mistakes we see outside of, I shouldn't say mistake, it's relative to a venture backable company, one of the challenges we see early on is that people get pushed into revenue too early. And being pushed into revenue too early can be an ankle weight on a company over the long term, because if they want to really disrupt a category, they're going to have to fire those customers, and that's a really challenging and difficult part of the plan. So, I would just say to investors, we want to learn as much about what you're seeing and what you're looking at, as well as we would share some thoughts on what we think a really venturable backable business looks like, and therefore what you should be looking for in a deck, as opposed to the feedback one may be providing.
Do you want to add it? Okay, great. Well, Chris and I can go all night, but really we're here to field questions from those that are here. So we're going to open it up to a Q&A from the audience.
One thing that there was a question that we didn't hit, and I don't know whether it would be hit in the audience, but I loved it, and I just see in the audience there's a great diversity of founder here, and there's a stat that you correctly identified that the percentage of venture capital dollars that are going to underrepresented founders, particularly female founders, is like horrendously low. And so just as these networks, we're trying to pool networks across the coast to the middle of the country, there is an enormous wave of networks that are focused around female founders, and I'd be happy to connect anybody to those.
Yeah, so one of the questions that we always ask, because we are very intentional about that, particularly because I think that, while a lot of people may think, well, they're too early developing the ecosystem, I actually think it's an opportunity for us to do it right and to do it inclusive from the ground up. So we are very intentional, and, the statistics are that from all the venture capital that's spent, less than 2% goes to women entrepreneurs and less than 1% goes to entrepreneurs of color. Thank you for touching on that. Appreciate it. Questions from the audience?
First, rather than a question, just to say thank you for coming this way. Thank you for what you're doing on the West Coast already. Have you captured enough on the results side to be able to make a case for what I think is a very smart bet on the entrepreneurship of immigrants? Have you had enough to be able to compare that to the general population and to attract investors that way?
Yeah, I think the real proof is dollars distributed back to LPs, which we haven't done yet. But directionally speaking, there's three major things to track. Number one of our hypothesis was, will our model of immigration really work for entrepreneurs? And so, which has been, we've now done over 100 filings for our portfolio founders, and all have been successful, with zero time overhead for the founders themselves. So that hypothesis checks out. Number two was these companies creating jobs and enterprise value. And so as we sit today, we just did this analysis for Q2, we've invested about 10 million and change so far, and the value of our equity in enterprise value is over 110 million. So that's based on applying the 25x forward-looking multiple on revenue. So understanding that a lot of our companies are still not in revenue because we invest at idea pre-product stage. And so so what I'm saying is that's underestimating the value of the portfolio, but directionally it tells us that we're moving in the right direction. We're partnering with the right kind of entrepreneurs. And then the third metric is job creation. And now our portfolio, again, fairly young, but we have more than 200 jobs that our portfolio companies have created. So the directions are all in line. People tell us that we're in the top decile of IRR performing funds, and we reflect back and say, we'll take that to the bank when we see exits and we can distribute back to LPs. But it's important. The success for venture funds is pretty binary, and it takes a good 7+ years to see. For in our case, likely 8+ years to see if your strategy is working or not. So you have to use these interim measures, and so far we're pretty proud of the kind of companies we're invested in. There's more than 300 co-investors or investors that have come on behind our investment in these companies, including some of the most popular names you've heard. So looks right.
Good.
What other question?
So when you're getting pitched and you're meeting with somebody, do you have a go-to question that puts the founders on their toes, or that is usually left off the deck that you're
Can you
always
also
asking?
introduce yourself just real quick?
Oh yeah, I'm Tyler Tokarczyk. I work at Inasmuch Foundation here in Oklahoma City.
Yeah, so for us, or for me personally, the go-to question is, what does the world look like if everything goes right? So it's not so much about putting the founder on their toes, but it's about seeing how big can they imagine. And we're very much the what can go right type of investor, not what can go wrong, because a lot of things can go wrong. And so that one really brings about that imagination.
What I normally do is ask about themselves and their founding story, their what started this for them, because oftentimes, although people are now coached around doing that out in the Bay Area, but oftentimes people leave that out of it and they just like jump right into everything else, and they miss the human element of it. And so I like to, when people are like fumbling with their laptop and trying to get the presentation up and something's not working, I like to just talk about your family, where they're from, things like that, and it actually doesn't get them off of it, or it does the opposite, frankly. It makes it you're actually connecting, and then you can take the conversation from there.
Hi, I'm Jonathan Yarber. I'm with Notecraft. I'm from Batch 1 here at the Launchpad. My question really goes out for our local investors. We operate in a near monopoly in how funds are basically raised out here. There's an organization that takes upwards of 9 months, which, I mean, for some early stages means that you have to go after customers just to have revenue to start the business.
That's 9 months of diligence, you said?
9 months from start to where you might actually start getting your check. So it's a rather long process, and it's fairly antiquated. My question comes back to, what advice would you give to investors that are trying to figure out how they might start sourcing their own deals, or going through their own diligence, or making those lead investments in local startups as a way to kind of break the mold, or stop participating in this antiquated process?
Smaller, more frequent checks. I think to a certain extent, when we want to learn a new category, we will make smaller investments into founders that we want to learn from. And so my sense is that if you have a 9-month diligence process for the early stage venture investments, I don't know the organization. It's a podcast. I'll probably be lampooned for it, but I don't think they understand early stage venture. And so my thought on it is that make smaller investments on a faster pace, and therefore you get more at bats, you get more iterations, and it may not be all the capital that somebody needs, but it will get them started. 9 months, and I don't know what that process looks like, and the overhead involved, and what that drag is on the founding team, but it may not be worth it.
Do you know what drives that behavior?
Is it an economic development office?
Can I address that since it's my company? I'm Carol Curtis. I'm with I2E. I know exactly what Jonathan's talking about, and it is economic development driven. So we do have funds, and we are working towards splitting our nonprofit purpose which is all about venture development, building companies. So in some cases it does take 9 months, but in some cases it takes 30 days. So we have a spectrum of different case studies that we could draw from, and we also do utilize an early stage loan that is provided through the state, through an organization called OCAS, that we can use to provide proof of concept study testing, so that is really a small opportunity. It's a loan, but we do deploy that to help founders pre-revenue to build their product and get it to a stage that we can use some of our equity-based financing.
That's great. That's great. And I should mention that on the other side of it, the perception side is an interesting one too, where I'm sure that a founder that I've invested in thought that it has taken 9 months, when the reality is that we were saying no for 7. And then
I completely agree with you, and we are working for the community that is local. We are working very hard at trying to change our perception in the community, because a lot of the thoughts around our process are based on 1 and 2 and 3 different companies that we've had to say no to, and because it is a small community, those stories seem to travel faster than those successful companies that have gotten through the financing hurdles and are working on their company. Does that make sense?
Yeah, I mean, operating alone is a tough, and I don't know if it's truly alone, I don't know, but yeah, we would like to Nitin's point about how do we combine our collective intelligence, so to speak. Learn from you guys, learn from us, etc.
I think that one of the things that we've seen in other markets where, that start kind of in the same basis that we are right now, I think that as the deals get more competitive and as the cap tables start getting more competitive, then investors are going to have to expedite their regardless of who it is, because they're going to miss out on the opportunity to invest. So I think it's a little bit too of the getting to that point where investors start realizing that we have great companies and that maybe we're missing out on the cap table because other people are starting to come here and invest in it.
I mean, this is a common more for the entrepreneurs. You cannot change how an investor operates. They're going to do what they think is right. But the opposite of your question, Chris, on what gets things done with investors is the convergence of greed and fear. So as an entrepreneur, what I try to do is create greed and fear at the same time. Greed that this is the next big company, and if I need to be in this to make the returns that I want to make, and fear that if I don't act right now, I'm going to miss this opportunity. The moment you can strike that, you're gonna change the process. I mean, you will see VCs leaving Thanksgiving dinners to go over to the founders to get the deal signed, right? So just as entrepreneurs, let's work on our circle of control and let's make our company and our team, our story so attractive that people fight over it.
Gotcha, and I appreciate that. One other question I have for you is, so for the companies that are raising from out of state, what advice would you have for finding that lead without maxing out your credit card on flying around everywhere and having those one-off pitches where you're hoping everything on this one pitch?
I can start with one very practical one, and the benefit we have of living in the Bay Area is that people often will do a fundraising tour in the Bay Area, and just a very practical point of advice is don't circumnavigate the Bay every day. Like if you're gonna set up meetings, be in SF for a day, be on the peninsula for a day. I literally have had founders that will be like, I'll meet you at 1, I'm leaving from Palo Alto. And I'll be like, all right, see you in 2 hours. So there's a very practical one. The other one is, it's kind of, to Nitin's point about greed and fear, you set a date for travel because you want a forcing function to get something scheduled. But then you send a couple emails, you don't hear back, and then you get two or three things scheduled, and then VCs are notorious for rescheduling everything. And so I would wait until you have a center of gravity for a trip. And when you have that, and you have anything of a friendly that can promise to introduce you to 1 or 2 other people, that's a great way to put together a trip.
Yeah, focus on that friendly, and nothing speaks better about a VC's investment thesis than their portfolio page. So look at that portfolio page, see if they've invested outside their region, right? There's a first for everything, but I don't know if you necessarily want to invest all the effort in finding out if you're going to be the first. So But if you look at the portfolio page, you look at the distribution of portfolio companies geographically, ethnically, whichever way you want to dissect it, and then target those VCs first. I would think most of the people in my network that I work with at the pre-seed stage, they're very comfortable doing most of the pitch conversations on video calls. When necessary, if it's about closing, either I will fly to you or you can fly to me, because meeting in person is important as well. And when we've invested outside Silicon Valley, I think about 40% of our portfolio is non-Silicon Valley. So we made the trips to DC, or the founders flew into to the Bay Area. And that's one time. That's easy to do when you know that this is at now 95% odds of closing. And now you have that one insider who can, someone like us, Ben, us, we do this for our portfolio companies all the time. Is we're going to make introductions, we're going to line up the meetings. And so when they make that one trip, it's worth the effort involved with the trip. It takes a lot of your time, and your time is much more valuable than the investor's time. You're building something much more impactful. So we'll do whatever it takes to optimize for your time.
Yeah, I think that's such a great point, because I would say that most newer VC firms won't ask you to meet in person for the first meeting, because it's not a great use of anybody's time. I don't care if you're flying or just driving from, I live in Oakland, and somebody else is going to meet me in the city, and they're coming from Palo Alto. That's like 2 hours of each other's time for like one meeting. Like, yeah. So, yeah, I like flying in for first meetings. I would stop that if people are doing it.
Okay.
My name is Leon Fowler with Influencer. I'm part of Batch 3. You mentioned a minute ago about kind of manufacturing or helping put together teams for entrepreneurs that are part of your portfolio. What's kind of the success rate of kind of manufacturing teams like that didn't organically kind of grow together? And what are some of the things that, one, I've experienced just organically putting together a team and splitting apart and it being just completely bad, to someone else putting together a team of people that they think could work together and then they actually do? And what advice you would say of make sure that you align in these different areas, because I think that's a huge piece.
I made one distinction in that we've never put together a founding team. We're not like, what was it? Was it NSYNC, or what was the band that like they were like Backstreet Boys? Thank you. They were like built, by a bunch of like music producers. It was very quick. You were very quick on that. There's been many times in which I've actually seen, like literally within the same week, 2 teams pitching, and I was like, man, if I could just take this person from that team and that idea from that team and this one person and make this like amazing. But that's tough, because the founding team, that's a marriage. It's trite to say, but that's. But we very often have put in like the 3rd, 4th, 5th, the founding engineering team or development team that's around them. And very high success rates. In fact, that's a lot of the advantage that we can bring of jump-starting teams like that. But one of the things that VCs often look for is the track record of that founding team, because that's a lot of what we're investing in. And if that breaks up, wow, that's a big challenge.
I think the advantage of having really large networks is all we have to do, and we've seen many successful outcomes out of this, is collide great people. So we're colliding people, portfolio founders with other portfolio founders with LPs, friends of LPs, just other people. The outcomes have ranged from multi-million-dollar contracts signed where the intention of that conversation wasn't a customer conversation. It was simply, they're doing something in your domain, they may learn something from you. And it leads to 3 months later, there's a multi-million-dollar contract. It leads to full-time hires where you're punching well above your weight as an early stage startup, getting someone to leave their late 6 digits, 7 digits job to join your company. but it happens when great people meet each other and there's just an organic collision of ideas, but there's a lot of trust and respect in that. So we get to do a lot more of that, and we're increasingly seeing, because there's so much success coming out of that, we're doing more and more of trying to just select or curate greatness. And if we're surrounded by great people and our portfolio companies are surrounded by great people, just good things happen organically.
Virtuous cycle.
So one last question. Yes, Carlos.
Oh, goodness, last question. Carlos Kesbers with the Oklahoma City Thunder. Thank you so much for being here. We're thrilled that you guys are here. Quick question. Traditionally, it seems that there has been the founders, the investors, and then the connectors like Chris and Erica that are running the accelerator, the incubator, the pre-accelerator. And in the past couple of years, there are these other kind of fourth, category, the brands that have come in that want to be involved, maybe don't know how to be involved officially, like the Thunder, but we know we want to be using our brand for good. My question to you is, have you interacted with brands like that? And are there suggestions that you have for us that can help better connect the investment community with the founders or the accelerators or the incubators?
You should be a venture partner with NextGen Venture Partners.
Great, thank you for your time.
No pitching. No pitching.
But no, I think that's very valuable, and we do see that a lot with established either brands or corporations, et cetera. And the biggest value that I think you can bring is that what are you best at? You run a business, and that business has domain expertise, and that domain expertise is going to be valuable to somebody's startup. And by being what we were just having the comment about what partnership means in different geographies. And partnership to us means somebody that is willing to be a design partner with one of our startups, that's gonna put time and resource to giving actual feedback on a product, something like that. And that is invaluable to that startup and therefore that investor, and therefore it's a virtuous cycle of, hey, this person did something amazing, what can I, and then we have a conversation with you, and I always leave a meeting like that saying there's an IOU here that I feel a debt for, and then I ask what's in your RFQ list? How can I help? What are you looking for? And then I have that bogey in my head of all right, I need to find a way to be helpful there. And so let's just all bring our domain expertise and bounce it off of each other. Pun, bounce it off of each other.
No.
Nailed it.
So Thunder, the OKC organization should give you a raise right now to retain you, because what you mentioned here is something that's lacking in most brands, self-awareness. So most brands, and I'm using brands more as this is something we see with corporations, with sports organizations, with entertainment brands, where they think they can do everything because they know everything, right? So we're going to be venture capitalists, and we're going to be acquiring companies, and we're going to run tech companies. Just the self-awareness that we're not good at everything, and we should trust people who are good at what they're good at and bring what we can bring. So, for example, Thunder has a platform. Now, if you were to collaborate with a startup that is in sports streaming business or something that is collaborative with your core business, and if you could get them extend them the platform, now you're using your strengths without scope creeping into things that you really don't know. The general experience the general sort of call it a mistake that I've seen is brands/corporations start doing things that are new to them without bringing in experts who have either done it before or are good at doing it. And so the best thing is stay aware and understand what your strengths are. And this is something we were talking in every tour I've been talking about, every these comeback cities tour, is really understand what are the strengths of our region or our organization, and use that to build network effects. Network effects is what accelerates growth. So one company you work with, it's successful, you will suddenly start attracting a lot more of these startups that now want to partner with you. You won't even have to approach them, right? They will come to you. Those are effects that just get built over time. So stay at it.
Well, we want to make sure that you guys spend time one-on-one with Nitin and Ben, so we're going to leave it here, but thank you so much, guys, for being here.